but we're walking through the fault lines in our economy, the fallout that could happen, and the shelter you can keep yourself protected financially if these things come to fruition. We have a lot of articles and graphs we're going to be walking through. I got the whiteboard in front of me for some of my visual learners out there, and we've outlined this for a while, so I want to be very clear. This is a detailed. Lock in with me if you are looking to financially prepare yourself for the future. Our economy is faltering and fault lines are beginning to appear. We're going to be walking through the 5 major fault lines that we see shaping into our economy, the 4 potential fallout phases we could walk into if these fault lines continue to spread, and then the shelter. How, if we were to go through this fallout, can we remain protected and even grow financially? This is show number 36 of the Zach Faust Show, and today we're going to be unwinding the economy. What's wrong with it? What signs can we see? What cracks are appearing in the foundation? And what can you do about it? For starters, let's bring up our beautiful Canva graphic so that we can start with the fracture. We have the fault lines, the fallout, the shelter, all around a video that we have called the fracture. Now, why have we called it that? Because our economy is indeed seeing cracks. We want to define those cracks for you, though, so we are on the same page with unbiased, nonpartisan, non-political, real data, raw and non-politically backed, so we can be very clear without the headlines and propaganda of where we are. So we're going to walk through the faults, then we're going to walk through the phases of the fallout, and then I'm going to tell you how you can make it out of it, how you can make it better on the other side of it. So with all that being said, let's get into the first fault, which is the dollar dilemma. The dollar at this exact moment is struggling. And this fault line, the dollar dilemma, which we can now reveal our first block. We have lots of blocks to remove today. Thank you, Sean. The dollar dilemma is a dilemma that is very, very pertinent. I'd like to bring us to our first article around that, around its strength. Now, the dollar has been weakening ever since the beginning of the year. In fact, it has had the weakest opening to the year in the last 52 years. Moving on to our next article, we're going to see that the dollar not only is losing strength, but it's also losing its financial might. This is a key indicator for us because the dollar at the moment is the world reserve currency. 60% of the world's reserves are in the dollar. So as the dollar is weakening, the financial might of it is also faltering. Other countries, other entities, they're watching our bond auctions. They're watching our market. They're watching our political circus and thinking, man, we hold a lot of their money. And so that might is slowly dropping, especially as the dollar is weakening. And that's a dilemma. So that's why we've created our 13 reasons why to go wrong with this Canva document, so you can know the 13 exact reasons why our economy is faltering. And the first one is going to be dollar strength. Dollar strength. When your dollar is weaker, you have less of it. Your $100 is now worth less. The combination of the dollar losing its strength and inflation is leading to less strength in your dollar, less strength in your savings account. Your everything from your real estate equity to your retirement account is worth less when the dollar is weakening. So that's the baseline fault that we can talk about, is the dollar. So let's move on deeper into the dollar. Let's talk about this thing called bonds. Now, bonds aren't confusing as we let them be. Not James Bond. Bonds are debt. When our country wants to print more money, when we want to have more government spend, we create more debt. The way we create more debt is we create these things called bonds. Now, the bond I want us to specifically focus on here for a moment is the 10-year Treasury bond. Let's bring up that article. The 10-year Treasury bond auctions have been weak, meaning there has been less demand for our debt. I want to read that first article, or that first paragraph, first full one. The benchmark 10-year note yield was up more than 2 basis points to 4.22%, while the 30-year Treasury yield climbed more than 4 basis points to 4.813, 1 basis point equals 0.01%, and yields move in the opposite direction. What it means by moves in the opposite direction is every time the bond gets weaker, the yield goes up. This matters to you. You may not think it matters to you, but it matters to you. If you don't invest in bonds, you care about this. Why? Because bonds equal rates. If we don't have rates that are low, you can't go get a new car, a new credit card, a mortgage. You want low rates. And lower yields equal lower rates. We don't have to get into how or why. We'll show a few graphs showing the correlation in a bit. But this is the 10-year treasury yield that leads to your ability to get long-term debt. And this bond has been going back and forth and back and forth with Fed rate cuts, with job loss reports, with layoff reports. And it's leaving the retail buyer, the retail investor, the normal everyday person that wants to get debt in a tizzy because rates remain high. Why? Because bonds remain high. Why? Because we have weak bond auctions. Why? Because people don't want to buy our debt right now. Why? Well, a lot of it has to do with the dollar. The dollar is weakening. The strength of it has fallen dramatically. And it's not getting started. It's happening. It's been happening. The worst opening to our year in 53 years. And I want to show a clip from a good friend of mine named Robert here in a moment. He is an incredible follow if you're looking for what's going on in the economy and you're just a nerd. That's the only way I could put it. If you're a nerd. If you're a nerd, you're going to like this guy's channel. If you're not, you're going to get bored by it. But Robert runs a channel named Infranomics, and he recently covered the last bond auction. I want to open real quick so you can hear his hook, his take around that bond auction, and then he's going to explain in as layman terms as you can what that bond market auction did. So let's walk through what Robert said real quick. Let's play that video.
We just wrapped up a 10-year TIPS bond auction, and it was awful with a huge tail indicating very weak demand. Here's what it means. So for those who are not familiar with our Treasury bond auction videos, very briefly, Treasury bond auctions are conducted in a Dutch auction style. What this means is you have a starting price, otherwise known as a when issued. Here we're trying to sell 100 units of product XYZ. The starting price, or the when issued, is $100. Well, you have to go down in price until all 100 units get cleared. And in this case, in a weak auction, you have to sell at an ever-increasing discount. The price has to go down, down, down. And remember, with a bond auction, what that means, the yield is going up. As the price is going down, they are inverse to each other. So you have to sell at a lower price or a higher yield. Well, what the tail is indicative of is the difference between the when issued, or the starting price, and whatever you had to go down to get the auction to clear. Everyone gets awarded the same price down here. In this case, $60 is what the auction clears at. However, in a strong bond auction, what you see is the exact opposite. There's so much demand that people are willing to pay a premium above the price or the when issued. And that's what we see here. Well, the difference between the starting price and, again, whatever it takes the auction to clear, the difference between those two is known as the stop through. It's the same concept of a tail, just in the opposite direction. You're selling at a higher price or a lower yield. Now, the other critical metric to know is the bid to cover. This is very simple. This is the total amount of bids divided by the total amount being offered. In this case, with the weak auction, you have a bid to cover only 1.0. Anything below 1.0, and that is what is known as a failed auction. Now, it's very difficult to actually see one of those.
So I know when you're listening to this, you may have gotten lost from the very beginning. Maybe you got that. But Infranomics breaks it down in such a great way. I highly suggest following him. He gives series and breakdowns that are invaluable for understanding a non-political based economy. Not what the administration says or this person from the GOP says, but what's actually happening. So let's go to the whiteboard real fast. I want to walk through what that meant. So when we talk about bonds, what we're focused on is this thing called yields. Yields just simply means return on investment. So when an investor is looking for a higher yield, they're looking for a higher return on their investment. And when a bond has a yield, so let's say a 10-year bond, what does that mean? It means the investor is going to have to hold that bond, hold this investment for 10 years. That's what's called the maturity date. And once they hold this for this 10-year period, they receive the full scope of their ROI. Now, the problem is when investors are scared of the economy, when they're scared of what's going on with inflation, when they're frightened by the weakness of the dollar, yields go up. And that's what we saw. We saw yields go up, and we've been seeing this happen all throughout the summer and now the fall. As these yields go up for 10, 20, and even 30-year bonds, what happens to you? What happens is mortgage rates go up, car rates go up, and all forms of debt goes up, like credit cards and student loans. So your ability to acquire debt gets more expensive every time we get a weak bond auction. This is happening consistently and constantly, and it is what has led to reason number 2 in our 13 reasons why the economy is slowly faltering is weak bond auctions. Weak bond auctions. We are going to touch on this a lot more. We have some Cayman Island stories as well as foreign investor tales to bring up, but that's the basis of the bond market. So, number 3, high cost of living. The dollar's weakness has led to higher cost of living. I want to bring up a CBS News article real quick so that we can walk through that under higher cost of living right there, Sean. Headline, CBS News. So this headline showcases beef, bananas, and other grocery items are becoming more expensive. Coffee beans even. This is leading to grocery carts becoming more expensive and it becoming more difficult for the regular everyday American to survive in our economy. Beef being a humongous topic as we're now exporting beef in instead of utilizing, instead of utilizing our own sources for beef, bringing in from other countries. It says as of September, the average cost of a pound of ground beef was $6.30, according to the Federal Reserve. My goodness. That's 65% higher than it was just in late 2019. Let's look at the CPI breakdown, though. We have another graph to bring up to show how those numbers actually physically break down. So if you want to look at this is on the Bureau of Labor and Statistics website. It breaks down all items of inflation. This is where we're getting our higher cost of living, y'all. When you're wondering why everything is more expensive, it is because of this very website, where we can look through and find that the labor of statistics has already shown us everything is more expensive. And that cost of living crisis that we're going through at this very moment is keeping the consumer down in an extraordinary way to the point where they're not able to even get by, let alone survive or thrive. Let's click on food real quick. Food away from home, food at home. Let's look at food at home. Let's look at food at home. So when you think about food at home, what's most important to you? Wine, alcohol, cheese? Well, if that's what you're interested in, you're going to be okay. But if you're interested in eggs and poultry and meat and fruits and non-alcoholic beverages like juice and, flavored waters, things that aren't soda and wine, those all went up in price. Let's go to Tradenomics real quick. Trading economics, that's another great graph. Trading economics shows us that inflation since January, look at this graph showing us since the beginning of spring and then from January, inflation has been here. It is not gone. In fact, in September, we had one of the highest inflation rates we've had since January. Look at the climb we've had since Liberation Day. April, right there, Liberation Day, all the way to now. Inflation is not dead. Now, corporate capitalism can be blamed for a lot of this. So let's look at what's going on with your power bill. Your power bill is going up, even though you're being told it's not. And the reason being, AI data centers. This is not some crikey, crazy, quirky conspiracy theory. This is actually happening. Mega corporate companies are buying up power centers, data centers, to basically fund their future efforts in the AI expansion. The problem with it is you're fronting the bill for their company's expansion. That's right. You're fronting the bill. How does that make you feel? When your power bill's going up, you are assisting in these mega corporate companies being able to one day be able to run their big, beautiful AI company. They're buying up the AI data center. They're getting it up and running. It's requiring more power to that general region. And instead of the company owner or the person who bought that data center fronting the new cost and the increase in power, it's getting socialized to you. You're the one paying it. So that leads us to the third reason why on our 13 reasons why database, or timeline, I should say, I don't know what we're calling it, is we have a cost of living spike. Quick story. I walked in the Wawa yesterday. Slow down for a second. I walked in the Wawa. Do you know, quick check in the chat. Do you know Wawa? Wawa is a deli gas station. And recently I walked in the other week and I saw somebody who I had sold a home to 7 years ago. 7 years ago. This is important because the market for buying a home was much different. I was able to get him a home. He made like somewhere in like the 48K range, making sandwiches. And I was able to get him home. No wife, barely any savings, had one car, got him a home. He's a manager now. And I would not be able to sell him a home at his current manager pay. Hear that. 7 years ago, I was able to sell him a house. No real problem. Plenty of homes existed, and it was easy to get him pre-approved. And now I can't sell him a home as a manager. Tell me how that makes any sense. So that's the dollar dilemma. That is the first fault in our 5 fault lines. We're going to be scooting, y'all. If you're just getting tuned in, this is going to be live on TikTok, but the recording is on Spotify and YouTube. Let's walk into the second fault line, because as your dollar weakens, you're also facing a wall in front of you, a wage wall. We're walking into a wage crisis, everybody. We're walking into a wage crisis. I'd like to bring up a few articles real fast, as we know that wages may look like they're rising, but most aren't keeping up with inflation. Oh, ad blocker. We didn't turn it off. Let's just go to the next article. It's all good. We're rolling through live. This is the first time we're doing this style of video, so a little bit of grace, a little bit of mercy. It's all good. So this is a graph I wanted you guys to see on the increasing gap between income and home buying power. So if we can zoom in all the way on that green line is income. At the very bottom, that is the median income of an American. We see back in 1985, it was about $22,000. But during that same year, a home was about $78,000. Scoot forward to today, the median income has increased to about $74,000. But the median home, if we scroll up to see where that blue line ends up, is now $432,000. So we went from about a 2.6% income ratio gap, 3.5% gap, to now a 5.8 price to income ratio on medium wages versus what people are actually making. Are you kidding? And they're blaming the avocado toast? Let's bring up this Fed article real quick. This is from the Federal Bank of St. Louis, Federal Reserve Bank of St. Louis. This is the actual report. Can you zoom that in ever so slightly on the definition so we can read the full definition? This is the median household income for the entirety of the United States. Now, I want us to go, can you click 5 years real fast? So look at from 2019 actually. Let's go to 2019. Let's look at where the income was, about $83,000. But what did you notice? If you see it, I want you to go ahead and say it. What do you notice happens to the income over the next 4 years? The median income in America. While companies are making record profits, while CEOs are making more than they ever made, the median income went down all the way till 2022. Now you may be thinking, Zach, wasn't this when we were printing a butt ton of money? Weren't we adding jobs to the economy? Wasn't money flowing around in stimmies? Yes, but they didn't pay people. And we can see it right here on this graph that we are now slowly climbing back to just where we were in 2019. Just back to where we were at in 2019. No gigantic jump. We're back to where we started. Let's move on. 1985 to 2025 is a significant difference. And anybody who was raised during that time knows it was a lot easier to get by. But we know also that one of the 13 reasons why that we're walking through this current phase is indeed a wage crisis. We do not have enough wages going around to supplement the demand of assets for getting the American dream started. People are struggling from left to right all across the board. I also think we're going to do this in parts. I think we might just cover only these fractures here today, and then we're going to get into the phases of fallout next week. I think that might be what we do. Let's get into B of our 13 reasons. It's the job market. The job market looks strong on paper, but if we scratch the surface, you find a generational fracture. What's up, Pop? Pop just entered the studio. Shout out, Pop. Let's bring up this first article about what Amazon is up to in the job market, because if we look at the job market or we listen to it, we may hear that, oh, it's strong. Federal Reserve says, oh, we're still doing good. Administration, there's no problem. Amazon just cut 14,000 jobs. It's actually 30,000 now if we look at other sources. And I think I had the other source in our next article on Newsweek. We have generational levels of layoffs that are happening at this very moment, from UPS to Target to Intel. Every single direction we look, we're now beginning to see layoffs. Even our own government looking to produce more layoffs, but being blocked right now by a federal judge. That's yet to be determined if we're actually going to see those layoffs happen. I believe it was 4,000 that we were going to see from that layoff. So we are posting this to YouTube and Spotify, just so you're aware. So we have a job market where the normal Gen Z were getting out of college, getting their degree, doing what they were told to do, is leading to a market where people aren't hiring. People aren't hiring. We're in a low pay, low hire, now slow to fire market. And it's leaving the Gen Z with nothing to really look toward. If I get out of college, I can't find the job. If I do find the job, the wages aren't going to be enough to get a home. And if I do get a home, that home is going to put me into a financial burden long term. Gen Z are struggling, and the job market is indeed cracking. Let's bring up this last little article. I just want us to read the headline. Gen Z are finding it hardest to get a job right now. It's not the boomer that's struggling. It's not the corporation that is struggling. It is the Gen Z generation struggling to get a job, struggling to get a home, struggling to get their hands on an asset that means anything, because the very job that they have may be replaceable, and the very income that they have doesn't even compare closely to what it was worth in the early 2000s, 90s, or 80s. So let's go back to our 13 reasons why. Reason number 5, the job market is cracking. Let's get into reason number 6. Reason number 6 is similar to the wage crisis, has a lot to do with the weakening dollar. It's inflation. Let's bring up a couple articles on inflation real quick so we can see wages versus inflation. I think this is a very interesting graph for us to be able to conceptualize and soak in, is what is the actual wage today if we factored in inflation too. And so if we look at the purple line here, we'll see the purple line is the one we want to focus on, but the orange and, was that maroon? Is that maroon? Got it. So if we look at average hourly wages, that's the maroon. They've gone up 21% since January of 2021. Follow me on this. Wages have gone up 21.8% since 2021. CPI index says that inflation has also gone up 22.1% in that same given time. So what does that mean? It means that over that given period of time, people actually make less money now. They now make almost a full percent less if we add in inflation within their dollar, within their paycheck. Their wages are worth less because inflation is ripping apart the dollar's strength. Now, this isn't something that, what are we pulling up? A Trump tracker, sweet. So I want us to show this real quick so that we can be ahead of the game later on, our Trump tracker. But the main basis of this is the fact that you're being told that wages are fine. You're being told that, look up housing affordability in the sheets. You're being told that your dollar is good enough, that you just need to work a little bit harder, when in fact the stats and the math show us the complete opposite reaction. Inflation has been ripping, we don't have to show it, Sean, it's all good. Inflation is ripping apart the everyday American, more specifically the Gen Z. Let's go back on. We don't have to pull that one up, dude. It's all good. If we it's housing affordability. If you look, it's yeah, right there. There we go. We can have that pulled up. Is that the next one we wanted? Perfect. This is our Trump tracker. Our Trump tracker is tracking Donald Trump's term and his promises specifically around housing against actual real-world metrics. And these are some index scores that we've given it to be able to track whether or not we're close to a crash, how much supply do we have, and how affordable is the market. We can see right now we are nowhere close to affordable. If you go to tab number 2, it's at the very bottom, Sean, we're going to see our bill tracker. We scroll all the way to the right, and this is a document that everybody has access to. Let's scroll all the way to the right, and we'll find the bill trackers. Now, everything you see in red is a bill that is more expensive now than it was at the beginning of the year. Look at this real quick. Every bill you're looking at that is red is a normal everyday household expense that is more expensive than it was this time last year. Soak that in. This is your everyday survival in your home. Going up, beef, every grocery cart item, coffee, car parts, car maintenance, used cars, car insurance, eggs, milk, power. We get into the cost of building a home, shingles, cement, appliances, water heaters. What hasn't gone down? Not much. Really, eggs is pretty much it, and that's coming off of the avian flu. We had a bit of a bird flu epidemic happening. So nothing is cheaper, all while the dollar is weakening and inflation hasn't died. So that's our 6th reason why, is real wages are just simply declining. Real wages are declining at a monster rate. And that's why we can't not talk about the fact that the dollar is weakening all while wages aren't increasing. This is the baseline of the whole core of the problem, guys. This is the number one fault in our economy. People aren't making enough money. If people made enough money, expensive homes aren't a problem. Expensive cars aren't a problem. Even expensive financing isn't a problem when you don't have enough money. And so we are going to cover the shelter and what to do, but we need to get to the third problem, the shelter squeeze. The third fracture in our economy is the shelter squeeze. Now let's slow down real quick. We've covered the dollar and we've covered wages. The dollar is weakening, not little by little, quite quickly. Worst opening to a year in 53 years. Wages have declined. 2019 to 2022 fell. And now only in 2025 are we getting back to pre-COVID levels. And this has all led to what we know as the shelter squeeze. People can't afford housing. People can't get into homes. People don't know how they are going to afford their mortgage, let alone get rent. So let's walk through a few articles I want us to see. This one, first one's from CNN. This is price to income ratio. Ratio. I love the headline to this article. America's housing market gained $20 trillion in value in the past 5 years. That is a large number. Is that 14 digits? It's 12, 13 zeros. Good God. That is a humongous number. America's housing market has gone up insanely over the last 5 years. Let's bring up our next article showing that housing affordability has been outpacing income for 40 years. This is from Statistica. Home prices outpaced income growth over the past 4 decades. They got a graph a little bit lower. I'd love for us to look at real fast to put it in perspective. The blue line is the median home per year, and the maroon line is your income. That stinks. And it's not sustainable. That's the whole point. It's not sustainable. And if we're in an unsustainable shelter market where the normal everyday person cannot get into a home, what are we talking about here? That's the baseline of American wealth. What's the gateway drug to American wealth? The gateway drug to wealth is homeownership. Most everyday Americans got their first bout of wealth from selling their first property. Hear me. Almost no person that is in this chat has gotten rich off of income. They've gotten rich or wealthy off of their home ownership, their retirement accounts, their IRAs, their stock portfolios, their bond holdings, their crypto holdings. Very few are getting rich off income. And when we're in a world where income, especially for Gen Z, is not enough to get started, all while the price of the home is exorbitantly more, well, then that means the Gen Z generation cannot get in on the wealth. They can't get started. So if the normal everyday Gen Z can't get a job, it's getting harder every day. Meanwhile, they can't get a pay for that job, even if they did get the job that's going to get them into the home because homes are too expensive. How does this generation get into wealth? At this exact moment, I don't think they do. Another big part of it is home insurance. Let's just skip down to the home insurance article. I want to finish with this one because home insurance is a non-talked about piece of all of this. Your mortgage is higher, the cost of the power bills are higher, and the cost of your insurance has gone up 70% since 2021. Let's bring up the article. 70% since 2021. So the taxes are going up, the home price is going up, your wages are going down, and insurance is going up. It's wild. So it gets us into the seventh reason why. Let's go back to our document real quick. Seventh reason why is going to be, right under that. Next one. Lots of expense. Oh, no, did we already remove it? No affordable homes? Yeah, my bad. No affordable homes. Let's get into the next one. Let's go ahead and reveal it. Just go ahead and reveal it. I lost the rhythm. Lots of expensive homes being our next reason. So let's get into reason number 8, ownership costs. So we already know home ownership is more expensive. Home insurance is up and price of the actual mortgage is higher than it's ever been. But living in the actual home is also more expensive. I have a couple items I want to talk about living in a home. So I have 8 items here. The mortgage, childcare, car insurance, health insurance, property taxes, the phone bill, the Wi-Fi, and food. If you were to pay for all of those things in 1985, you're going to be paying about $2,200 a month. Today, it's about $7,900. Hear me. If you were to pay for all the main core items in a household to raise a young family, put your kid through childcare because you both got jobs, both of you got to work, you can't do the single income thing. You're not even putting money aside. You're just paying your phone bill. You're just getting internet in the house. You're just getting power. You're just getting food. If you were to pay all those things in 1985, $2,200, and on average, the median, they're making $2,500 a month. Today, it costs you $7,800, $7,900 a month to upkeep that household and family, all while the median household income is nowhere near that. So we have a problem with not only the cost of the home, the inflation that's happened to the dollar, the wage crisis that's suppressing the job market, but even if you get into a home, now the cost of the home itself, you have to keep paying this every month. The mortgage, the insurance, the taxes, the power, everything that goes into the fridge. All of it's more expensive. That's why reason number 8 is the fact that there are just more expensive homes out there. We don't have affordable home options. So for all the boomers telling you, well, just buy a small home, put some elbow grease into it. They're not out there, Pops. Shout out Pops in the background. They're not out there. The cheap $200,000, $300,000 home, it does not exist. Even in Delaware, one of the cheaper markets in America, you're still looking at a home that's $360,000, $340,000 usually to get started. $290,000 to $315,000 is tough. And then, of course, you get into the home and the insurance is higher, the food is higher, the power is higher, everything's higher. So let's move into reason number 9. Reason number 9 that many Americans are struggling in the housing market isn't just due to the fact that there aren't affordable homes or that there's lots of expensive homes, but that what we're heading for in this housing market isn't what you want to see. Most people want to see home prices crash. But the problem is we're more than likely going to see something worse than a crash. That's where we get our ninth reason. Prices will probably keep going up. And we have some articles to showcase why that might be. First one is from, how do you pronounce this? Reuters? Reuters? How do you pronounce this one, Pop? Reuters. Like roids, like steroids. That's how I'll remember it. U.S. single-family home prices increase in August. This is the most recent month we have the data for. Home prices are still going up. Now, if you were to go into the real estate ecosphere on YouTube, you are going to find some people who say, oh, home prices are dipping. They're going down. Guys, Dallas, Texas, Austin, Texas, a little bit of suppression. Southwest Florida, doomed for a crash. California, way too expensive. People are getting out. Prices are slowly going down. And if you look at the hurricane-prone states, Alabama, South Carolina, Georgia, Louisiana, you are seeing missed mortgages and some price compression. But everywhere else, prices are going up. Zach, I see price reductions in my market. Just because they're reducing the price and what they want to sell it for doesn't even mean the first price was the actual price. It means they were trying to get more than what it was worth. There is no housing market right now that isn't more expensive and increasing in price. And especially if we look at the Northeast, the Mid-Atlantic, or the Midwest. I almost said the Middle East. I don't think we're buying houses out in the Middle East. The Midwest of America, home prices are going up. Let's go to this Reddit feed real quick. I thought this was a very interesting sentiment. I love Reddit. Reddit be having some good stuff. So I saw this initial article. Let's read the initial article real quick, and then I want to read some of the comments because all the comments were perfect. Are prices going to drop ever, or are home prices just going to keep going up? If you're in the chat, I'd love your sentiment. Are they going to go down, or are they going to go up? But let's read these few comments in this thread. It says, most of the time, prices will either be stable or go up. In unique periods like 2008, where home prices fell, I'll add on to it, had a lot to do with subprime lending. The next comment says, and when house prices fall wholesale in large amounts, it's bad news for like 98% of the population. And that is true, because usually this is led by bank failure and unemployment. Would also like to add that when it comes to selling and buying a home, there is no right time. If home prices fall, you'll just have to sell your home price for a lower price and buy a new home for that new low. And if home prices go up, you will have to sell high and buy high. Next one. Last one. And this is exactly a part that makes me laugh at folks who just want to wait until they get the best deal. I'm not laughing at you. If 2009, 300,000-ish homes, now 500,000-ish homes, you are worried about that 200K increase. When most likely the catastrophic event will send the market back down is 99.9999999% going to impact you, and you won't be able to get the mortgage. This is what happened in 2008, by the way. This is what happened when people saw home prices dropping. Why do you think a bunch of people didn't just go out and buy homes? Home prices are cheap. Because unemployment started rising. Credit started crunching. The normal everyday American couldn't get a mortgage. Banks weren't even giving out mortgages. They were frozen. And the biggest part for me is the amount of people that even have mortgages. I just want to show the screen real quick. I just circled a big number on my whiteboard. 39.7% of homes in America. I should put that. 39% of homes in the USA don't have a mortgage. So what is going to force them to sell? Oh, let's give another stat real quick. 1 out of 3. 1 out of 3 homes in America is bought by an investor. Okay, let's do another one. 48% of the nation's real estate wealth is held by boomers. Ask me how any one of these 3 categories gets so financially impacted that they're forced to sell their home for 20% of the value. Ask me about that. When the boomers hold the most, investors buy 1 out of 3, and then 40% nearly of homes don't even have mortgages. And by the way, you may be thinking, the silver tsunami, boomers are going to die soon. Did you know that there's no time in our American housing market or even our economy whatsoever where we can find a generation dying off and giving their assets back to the supply of the economy? Almost always they stay internal. And I'd also like to say this. If we're in a market where the average Gen Z grandchild isn't able to get a home, what do you think is going to happen when grandma passes? Do you think that they're going to just sift it to the market and say, here you go? No, they're going to give it to their grandkid. I'll tell you, and everybody sitting in this room, Pops definitely knows that when someone calls to say, grandma died, grandpa died, Uncle Tim passed, I need to sell the property, we're usually only getting the call for one of three reasons. One, it's land. Two, the home is not ready to live in and needs a lot of work. Or number three, it's ready to live in and they're going to live in it and they're transferring it and they just want us to tell us what it's worth. They just want us to tell them what it's worth for the bank or the realtor or whoever. They just want to know what it's worth. So when it comes to the silver tsunami, the big boomer sell-off, to me, it's a carrot on a stick. To me, it's a carrot on the stick. And that's why it's the ninth reason why. Because home prices not only are unaffordable, the cost of living in that home is no longer affordable, but the more than likely scenario is home prices keep going up. So let's get back into our graph. Let's go to our fourth fault line. Again, recapping. We have a dilemma on our dollar. The dilemma is it keeps weakening. Your dollar is not as strong. Number two, we have a wage wall. People aren't making enough money. Number three, we have a shelter squeeze. People can't get into housing, and when they do, they're getting squeezed out of it. So what's number four? Number four is our good friend right there. Look at that beautiful family photo of Mr. Jerome. I don't have a good Jerome Powell impression. I'm imagining it would sound old. Number four is the great rate debate, the rate trap. Now, you may be wanting lower rates, but can I tell you the Federal Reserve, who's in charge of our federal funds rate, the internet or the overnight bank rate, which, by the way, if you've missed any of this is recorded and going on Spotify and YouTube. We're covering the 5 segments of the faults in our economy. Next episode, we're going to go through the 4 phases of the fallout, and then the third part will be the shelter, how you can protect yourself, how you can get out of it, make your way out of this profitable, not just surviving. If we look at this rate debate, it's honestly silly because we have one side that wants rates low right now and another side that says rates need to stay high. Well, what's the side of each debate? Well, one side wants lower rates because they want to be able to finance more debt. They want to get a car. They want to get into a home. They want to get a new credit card. They want to buy a burrito on DoorDash, and they want to be able to finance it for a low rate. And there's also the government side that wants low rates because they want to refinance our government debt at a lower rate. But why do people want higher rates? Well, I'll be honest with you. I'm on team higher rates. Why? Because we're walking in the stagflation. And we're going to cover that longer in this or more in the series in detail. But we're walking in the stagflation. And the only way we were able to solve that in the late 70s was via obnoxiously high rates. The problem is, in the modern day, we have a new tool that we'll walk into later on. But first, let's just cover the basis of stagflation. Stagflation, I'm going to clean off my board real quick. Stagflation is simply when we have stagnant growth and inflation. And when we have stagnant growth and inflation, let's see, stagflation, we have a juxtaposition, a catch-22 that the Federal Reserve is in with rates. Because their Fed rate can only go up or down. And if they were to go up or down, they're going to have residual effects on the job market and inflation, the two things that they're in charge of. They're in charge of the job market and inflation, prices. Let's do that. Job market, inflation. These are the two core mandates. The Fed rate, the rate that they control, if it goes down, what is this going to do to their two mandates? It would up jobs, improve the job market, and increase inflation. So if they were to drop their Fed rate, we're going to get an increase more than likely in inflation and an increase in available jobs. Because when credit is freed up, usually more jobs are able to be created. But when more credit is freed up, typically that's an inflationary sign. Now, what happens if they move the Fed rate up? If they were to move the Fed rate up, we are going to have less jobs. And we're going to have less inflation. Now, you may be asking yourself, How do we get it so that we can have more jobs and no inflation? How do we get these two to happen? The answer is the Federal Reserve has no clue. They've been asked several times. They don't have an answer. They have stated numerous times that they're going to stay in a neutral standpoint if this begins to happen. But if you watched the last Federal Reserve meeting, I did. Don't worry if you didn't. They were asked about stagflation. They still don't know what they're going to do. Because at this very moment, if they were to cut rates significantly, inflation would reap its ugly head once again. And if they were to keep rates high, they more than likely would crack the market, especially the job market, if they tried to tame inflation back below 2%. So what I believe the Federal Reserve is going to do, and why the rate trap is such a significant part in our conversation today, is they're going to, one, leverage their new Mauska tool that they were not able to leverage back in the late 70s when stagflation happened. And number two, I think they're getting rid of their 2% inflation goal. I think, honestly, they're done with this 2% inflation goal. I just lost my glasses. Oh, well. Because we are seeing them cut rates in a market where inflation is still at 3%, where core goods are still up, from shelter to food to everything you need, from beef to oil to electric, is up. And when inflation is up, you're supposed to keep rates high, guys. Like one more analogy. When the market is a frown, what do you do with rates when the market is a frown? If you know the answer, comment it. When the market is a frown, rates go down. I want you to think 28 and 2020. Two easy examples. When the market's a frown, rates go down. When the market's on fire, rates go higher. Now, when Donald Trump, if you're listening to this, Donald, hi, when Donald Trump talks about our economy and rates, he will say, and has said numerous times, Jerome needs to lower the rates. Our economy's on fire. We're white hot. The stock market's doing incredible things. Inflation's dead. Well, if the market's a smile, our rates need to go higher. We only go down when the market's a frown. So how can we simultaneously have a white hot economy and need to cut rates? It doesn't make sense. It doesn't make sense. I love investing in silver. Someone just commented that. We're going to hit on that in the shelter, how to prepare yourself for what we're talking about and thrive on the backside of it. Right now, we're just going through the faults. Not trying to be negative Nancy here, but we're just walking through the faults. The 13 reasons why you're right. The economy is kind of weird right now. Reason number 10 is the rates. The rates. Because it's going to lead to printing. If we keep doing this, we're going to have to print. So let's get into reason number 11. Reason number 11 for this is something that I've been talking about for a year and a half. The big old brrr word. I think I've gotten pretty good at that, Sean. The big old brrr word. Who does that? Cardi B? Is that the brrr girl? I think it is. I don't know. I don't know anything, dude. I don't know anything. That does sound like I'm glitching. Reason number 11 is quantitative easing. The money printer's about to go brrr. I don't have a Mr. Krabs impression. That was as good as I got. So Mr. Krabs, the Federal Reserve, printing money. I want to walk through a graph real quick of the history of the money printer so we can just see real fast what is happening when we print money. Now, there's two different types of money printer. Let's go to the whiteboard real fast before we do this. There's two different types of MPs, money prints. There's bank bailouts, BBs. We love BB. There's bank bailouts, and then there's quantitative easing, QE. QE is Federal Reserve printing, and bank bailouts is legislative printing. It just went 0 dark 30 on my screen for a second, so I'm operating blind. We're going to keep going, though. Oh, we're skitzing. We're good, though. The screen should still be fine on your guys' end. Our side just got a little wonky. So QE is when the Federal Reserve decides they're going to create new money on a computer and go buy assets. Those assets are going to be bonds and residential mortgage-backed securities, sometimes commercial-backed securities. I'll put that back in there too. They're buying mortgage-backed securities and bonds with QE. Now, bank bailouts, this is Occupy Wall Street. This is when we're talking about 2008. Families were getting foreclosures. Banks got bailouts. TARP. T-A-R-P. You can look up TARP for the last time that we did a bank bailout. TARP was when we allocated $700 billion. 400 ended up getting utilized. $400 billion toward banks getting bailouts to the top line item of their account. And that was it. There was no, hey, you have to create a mortgage program to help people stay in their home. There was no foreclosure prevention fund to keep people from losing it. There was nothing to help the person that was unemployed. No, if you watch the PBS Frontline documentary, The Age of Easy Money, will know that Ken Lewis, the president at the time of Bank of America, who was let out shortly after this time period, was told by the Federal Reserve, by Treasury Secretary at the time, not Scott Bessent, who was that? I forgot his name. Oh, man. Told them, you have to sign this document. You have to take this money. If you don't take this money, you're not in the cool kid club anymore. And bank bailout money is that money printing. I want to be clear. Quantitative easing from central bank. Sean, if we can, the one right above the door. Oh, there it goes. We're on. There we go. Now we're in. Quantitative easings from the central bank. Bank bailouts from legislation, from lawmakers. All right, so we clear on these two things? If we're clear on these two things, we're going to move on. QE, though, is coming. So we're going to bring up this graph real fast to show you what that does to our economy when QE is coming. Now, this is the assets that are owned by the Federal Reserve. You can see that they didn't own quite a lot before when? 2008. 2008. That's key. 2008 was when we first enacted quantitative easing. Quantitative easing is when, and I may do another whiteboard graphic for us on this one in a second. Quantitative easing is when they buy up bonds, the Federal Reserve does, to keep rates low. To keep bond rates low. Sean, I think it's this connection right here above the basement door. There's a little connection of the HDMIs. If we replug that in, I think it'll stop having the problem. Heck yeah. So with that being said, we know that when things get tough and the bond market starts to crack, what happens? Well, in 2008, what happened is they printed money, QE. In 2020, what happened? They printed money, QE. So in 2026, what we are more than likely going to see happen is we're going to see QE. Quantitative easing to buy up assets and add it to our balance sheet. And if we look at this asset graph, what we're going to see is from 2008, and then again in 2010, and then again in 2014, and then again in 2020. Sean, I think it's this connection right up there. It's that dongle right there between those two HDMIs. That's the loose connection. Sorry, we're having some technical issues on the back end. Yeah, we're good to go. Nice. Now we're good. Now we're back in normal formatting. Thank you for your patience. So with that being said, why do we think QE is going to happen again? Because the rates aren't going down. The bond market, which we already talked about, is cracking. We have weak bond auctions. We have weak demand for our debt. And when there is weak demand for the debt, we have to come in with QE and buy up the bonds that nobody wants. Let me write this out on the whiteboard real quick. So QE, I want us to all understand why QE is the absolute worst thing ever. QE was invented in 2008. This is the first time we ever did it. And what it was is we get this magic money computer. I'm going to make a quick little magic money computer. And we add money to the supply. How do we do this? We call up a bank. That's a piece of mac and cheese. We call up the bank, the Fed does, and says, hey, you have a bunch of bonds and securities. We just used our magic money printer to print up a bunch of new money. And what we're going to do is we're going to buy those off you. They're ours now. Thank you. They're going to buy those bonds off, put them into their magic money computer, their balance sheet, and they're going to hold these off market. Now, what happens when you hold something off market? Simple supply and demand breakdown here. If you, this is you, all right, if you are selling, say drugs, you're selling drugs. See this little drug right here? You sell it. Now, when you sell drugs, you are in the business of making a handshake connection between a creator and a consumer. You're the person in the middle making the handshake happen. Now, of course, this is a black market, so it's a little bit more devious. But in this case, as you grow and your distribution goes up and your wholesaling of the drugs keeps getting better and better, you're doing so good at the dealing, great job. Well, what happens when people stop buying your stuff? What happens when the buyer starts to dry up and you're not selling as many? Well, you have a few options. Either A, you could lower the amount you're manufacturing. B, you could lower the price. Those are really your two options. Now, what does our Federal Reserve do? When we start to see less people are buying our debt, and we've been dealing our debt, the other four-letter D word, not drugs. We've been dealing our debt for years to buyers. And the buyers have been buying because the dollar's strong, the economy's strong, the debt's not crazy. What happens when we get less buyers, when foreign demand starts drying up, as we've already talked about? Well, they have two options. They either lower their supply or they lower their price. The problem with lowering the price is if they lower the price on the bond, the yield goes up. If the bond price goes down, the yield goes up. And if the yield goes up, everything for you, from a mortgage to a car to a credit card, all of these get more expensive. So instead of allowing themselves to lower their price, and instead of having less debt, because they can't do that, we need more debt, instead they do the third option. See, if you're dealing drugs, what is the number one rule? As somebody who doesn't, I'm assuming you are not one who deviously, puts themselves into the black market to sell off things that shouldn't be sold. But what's the number one rule of selling these? You don't get high on your own supply. You do not buy your own stuff. That's not the rule. You can't do that. So what does our government do? When people aren't buying our debt, when we're losing demand, what we do is this thing called QE. We get the magic money computer, we print new money, and we supplement the demand by buying what wasn't being bought. Then we buy even more. And what this does is it brings the value of the yield up, which brings the cost of the yield down. And that brings retail rates for mortgages, cars, and credit cards down. I hope that makes sense. Somebody said in the comments that number one rules don't get caught. That's fair. That's probably a good rule number one. Rule number two is don't get high on your own supply. So QE is disgusting. We are creating money out of thin air, which inflates the economy. And then we're buying up bonds to create false demand to remove supply that should healthily remain on our free market. But we don't do that. Instead, we buy up our own supply. And that's why it is reason number 11 in our 13 reasons why. It is a huge crack in our economy, and it's going to happen again in 2026, which we will cover in our 4 phases of the fallout. Let's go back to our Canva document to unveil number 12 in our 13 reasons why. Oh, actually, we got to go back to you're right, Sean. Sean knew it. So let's slow down real fast. We have a dollar dilemma. The dollar is weaker. Inflation is taking hold. We have a wage wall. People aren't able to get a job out of college, and if they do, they're not making enough to survive. We have a shelter squeeze. People, even if they get the job and make enough and their dollar is strong enough, they can't sit in the home and even live in it. Their power bill's too high. Their insurance is too high. Everything from beef to a new car part is more expensive. And then we have what's keeping it all happening, this rate trap. If we were to raise rates, it could solve problems in the long term, but it could crack the economy irreparably. And if we lower rates too fast, we're going to cause inflation and frankly, not really help anything else. So what's the fifth issue? The fifth crack in this economy is the obvious one, the one we've been going through for 40 years, the one that every person and their mother will agree on that we do way too much of, and it's government spending, which is leading us into a debt spiral. We can't stop printing money. From everything, you pick your subject line item. We cannot stop printing money. Can we bring up the U.S. debt clock? You ever seen the U.S. debt clock? It's a very overwhelming graphic. This is all of our debt in different categories. Look at all of, and they're all actively running. Zoom in on a random one, Sean. They're all actively running and moving. Actively running and moving. So there's a couple ones that I want to keep, key line items we're going to bring up, but let's start with the total at the top. Total at the top. U.S. national debt has passed $38 trillion. $38 trillion. What does this all go to? A, if you really want this detailed answer and you want to take some time, look up the U.S. debt clock, and then you'll be able to find where every single dollar goes. But one that I want to point to, I love that they have the Doge clock on here. That's cute. I love that they have the Doge clock on here so we can actually see that the $691, billion goal that's needed to be hit keeps growing, and the actual clock of what they found is such a small amount in comparison to the total debt. So let's scroll down real fast to right there, just the next line item down. So go up just ever so slightly to the red one. Perfect. Over to the right. Over to the right a little bit. I don't know why this little graphic keeps coming up. Keep going, keep going, keep going. And then up to the one that's in those yellow and black lines. All right. So you see these two right here in front of us? This is what I want us to conceptualize. Who spends the most on their military in the world? If you get that question wrong, I don't know who you are. Who spends the most on their military industrial spend in the world and profits off of people bombing people, rebuilding cities, bringing freedom? We love oil. How much do we spend? $922.97 billion on the military. It's America. America. But what do you notice just to the right of it is now a larger number? Interest on debt. The largest line item on our debt used to be our military. Do you know what the largest line item is now? Paying the investors that hold our bonds. Paying the investors their yield. Remember the yield? That's it. The dollars we have to send out, foreign, domestic, retail, retirement accounts to the baseline of most 401ks, all of that is being paid at all times. And as the rate goes up, so too does the cost of that debt. The only way we can get the cost of that debt down is by refining at a lower rate. The only way we can get rates down is by convincing the bond investors that our economy is strong. And when we fail to do that, we will quantitative ease to print money. Does that make sense? Does that make sense? I want us to be on the same page about why this is going to happen. Because we're not going to go sovereign. We're not going to just declare bankruptcy and say we're not going to pay off debt. That's not going to happen. Nobody else in the world is going to come and supplement our problem, save our problem. Nobody else could be the world reserve currency right now. Our only option is to print and keep the game going. To keep the can kicked down the road, the debt explosion going. And that's why it's a major fault line in our economy, is because we can't stop it. The debt is soaring. It's not becoming a monster. It is a monster. We're not getting the debt to GDP spend to a correct percentage. Many people think it needs to be about 3%. Warren Buffett, Ray Dalio, Thomas Sowell would say. And it leads many to believe, how do we stop it? I don't believe we will. I believe we're going to keep printing. We're going to keep adding money. We're going to keep printing money. We're going to keep adding money. We're going to keep printing money. And if you ever get to the point where your family's possibly facing foreclosure, guess what? When families are getting foreclosures, banks get bailouts. Let's get to our 13th reason why. Now, when we talk about bonds and we talk about debt, Oh, yeah, we have to do that one. My apologies. Debt explosion. Oh, we're done. Sorry. Debt explosion. But the 13th reason is not just the debt exploding. Because if we had more debt, that's one thing. If people were willing to buy our debt, that'd be one thing. But the problem is we are losing foreign interest in our drugs, in our debt. They're like, guys, your booger sugar just isn't hitting the same anymore. Like I used to get a nice buzz off of this, and now I'm just a little scared when I hold your dollar. Bond investors used to be like, yeah, buddy, this is a AAA investment. Now it's not. Yeah, inflation isn't going to be a huge issue. Now it might be. And so foreign investors has been tapering off. I want to tell you a quick, we're going to show some graphs here in a moment, but I want to tell you something really fast before I show you how these bonds are declining. Do you know, real quick, if you know it, guess it. Guess it in your head. Comment it. Write it on your hand. Who holds the most of our debt in the world? Who holds the most American debt in the world? If you said China, it's not. If you said Japan, nope, they're second. If you said the UK, they're third. China's fourth. The Federal Reserve actually launched an article 2 weeks ago that said they miscalculated the holdings of our debt. That China, Japan, who have been selling our debt, by the way, they are not on a surplus. They have been selling. They're not the number one holders of our debt anymore. Now, it's obvious who the number one country that holds the debt is. It's America. America holds the most. The Federal Reserve holds the most of anybody. But foreign countries, who holds the most? Who's number one? It's not China. It's not Japan. It's not Germany. It's not Australia. According to the Federal Reserve, our central bank, when they redid the numbers, they realized they were mistracking something. The number one holder in America's debt is the Cayman Islands. The Cayman Islands is the number one holder in America's government debt. The Cayman Islands are the number one holder of America's debt. How many times do I have to say that for us all to understand how atrocious that is? $1.8 trillion of our country's debt is being pushed around through shell corporations off coast. Not by a major company, not by a major country, but by hedge funds that are holding assets off market. Why? Because if they allowed them on market, we wouldn't have enough buyers and our bond market would crack. We are actively buying our own supply. We are lit in a corner right now on our own supply. We are Fenty folded in our own supply at the moment. Double China, nearly double Japan, triple Germany and Belgium and all these other countries that hold our debt is being held in offshore accounts. What this means, there's really only two options here. Either A, this is a foreign government that is attempting to weaponize our bonds, potentially to hold them off market, to at one point sell them in mass and throw a flux into our bond market that could crack it. But I don't really like that theory because China and Japan, they could get together and do that right now with what they already hold. So I don't know if I like that theory. The second theory is that our government has found that we're not getting foreign buyers on our bonds. And to make the bond markets look better than they actually are, we're sending in fake companies, seemingly foreign, to buy up the bonds. Who knows who it is? But not just a small amount is held by them. They're the number one holder of our debt. We're going to print money to solve this problem. It's going to crack our economy in more ways that I could say right now. Want to bring up a couple articles, though, so we can just talk about this. Let's look at the 10-year Treasury bond. Yields might reach 5.75%. We're in the fours right now. That means your mortgage rate, by the way, would go back above 7%. We don't have demand for bonds right now. If we had demand for bonds, we wouldn't be having these problems. Look at this real quick. Foreign holdings of U.S. Treasuries hits 12-year low. 12-year low, and I'll add the caveat, that includes the Cayman Island holdings. Even if we include the Cayman Island holdings, we're still at an all-time low. So what gives? Quick drink. Sean wants us to read this, so we will. Good call. Foreign central bank holdings of U.S. Treasuries at New York Fed just dropped to $2.78 trillion, the lowest level since 2012, shrinking by $130 billion in just 2 months. Just a little bit. Just a small, teensy tiny bit. And by the way, that's all while the foreign entity of the Cayman Islands is buying up already. Hey, Sean, real quick, can we look up? I'm curious. What is the GDP of the Cayman Islands? The GDP of the Cayman Islands is $7.1 billion. So 7, let me see, 7,139, and then what's that? 1, 2, 3, 1, 2, 3. Yeah, that's it. Okay. So $7.13 billion. And then they hold 1,800,000,000,000,000,000,000. So their country is worth this, but they hold this much of our debt. Anybody else? Any questions on why that's weird? On why that's probably not legitimate? What are we talking about here? This is a shell company entity, which, by the way, if you're curious, Bermuda and shell companies like them in the Caymans have been used for decades to hide money, hide toxic assets. This was one of the main line items in the Paradise Papers with Jeffrey Epstein and JP Morgan and Morgan Stanley and Bank of America holding money offshore so that the toxic assets they were holding weren't seen at their quarterly meetings. When they have bad stuff on their books, when they're cooking the books, they move it offshore so nobody in the public eye, as I karate chop my mic, nobody in the public eye can see it. This is the exact thing that they were doing before 2008. Jeffrey Epstein was the chair of Liquid Funding Limited, who created toxic mortgage obligations for Bear Stearns, and Bear Stearns was the first bank that collapsed. Also, it collapsed 3 months after he went to jail for the first time. That's a little weird, right? And then he went to jail again in the summer right before COVID. That's weird. That's tinfoil hat, though. So let's go back to our 13 reasons why and walk through them real quick. The 13 reasons why our economy is headed toward a shift are the following. The dollar strength is low. The bond markets or the bond auctions are weak. The cost of living has spiked and is continuing. We're in a wage crisis. The job market is cracking, especially for the Gen Z generation. Inflation has ripped apart real wages to the point where we are now making less than what we actually made in 2019. There are no affordable homes. There are lots of expensive homes. And of the homes you can get your hands on, the prices are going to keep going up as you live in them. The rates are high, and we're more than likely going to print money to make it stop. And that's why the money printer of Mr. Krabs is going to go burr. And that's going to further our debt explosion, which is already above 38 trillion, headed toward 40. And why are we going to do that? Because foreign buyers aren't buying our debt anymore. And if foreign buyers aren't buying our debt anymore, we have to do the age-old phrase of getting high on our own supply. Now, we're all on the same page of why our economy is shaky, why there's clear and obvious fault lines that aren't just showing up, but are present, cracked through the foundations of what we know as a modern free trade, capitalistic focused economy. If we can agree on that, then what I'd like to tell you is what's going to happen next. Because if we can understand where we're at right now, non-politically, not blue or red, just looking at green, then you can understand the next 4 phases of the fallout. The fallout's coming. I believe in the next 5 to 6 months, probably sooner, we're going to start seeing these shifts. I'm going to tell you exactly what those 4 shifts are going to be. And following that, I'm going to tell you the shelter. How, when this fallout inevitably happens, can we go to the screen real quick? When the fallouts inevitably happen, how you can have shelter. And I mean that figuratively and literally. I want you to be in a home. But we have 5 faults. We just walked through them. These are our 13 reasons why. That was an accident, by the way. It was 13 reasons. And when you just adapted into the TV show, that was a weird show, by the way. Maybe a little uncomfortable. Fallout. There's going to be 4 phases. I'm going to walk you through these 4 phases on our next episode. And then the shelter. There's 4 foundational pillars that you need to have, not only in your portfolio, but in your life, in your brain, so that you can survive the 4 phases of the fallout. We just went through all of this. It was a lot of information. It's also the first time we've used an outline as we go along, so it was a little tricky at the beginning. Forgive our chemistry as we move forward. I'll do better. I can't say enough how important it is to know what's going on right now without a political jading. Because if you hate Trump, whatever, doesn't matter. The economy is going to be the economy. If you love Trump, doesn't matter. The economy is going to be the economy. We have to look at the nonpartisan facts. We have to look at what the investors are doing. We have to follow the money and see where it goes. And the money is leading toward a reset. We're going to define what that reset may look like, what the 4 phases of this inevitable soon-to-come fallout is going to be, and how you can shelter yourself from it, not only in a physical shelter, but financially and spiritually and mentally between your own ears. This has been episode number 36 of The Zach Faust Show.